Hey, I'm Sawant, a research analyst at Mirae Asset Sharekhan. The Reserve Bank of India has announced its 2026 June monetary policy, and the big takeaway is a hawkish pause along with push for attracting foreign capital. Let's decode what that means for growth, inflation, and markets. First, the headline decision. The repo rate remains unchanged at 5.25%. Alongside that, the SDF rate stays at 5%, while both MSF rate and bank rate stay at 5.5%. The Monetary Policy Committee has also retained a neutral stance, meaning future action will depend entirely on dynamic incoming data. So you might be thinking, why the pause? Because the RBI is balancing two opposite forces, which are first, rising inflation risk due to supply shocks and global uncertainties, and second, growing risk to economic growth caused by higher energy costs and weaker global trade. So, instead of acting too soon, the RBI is choosing to wait for more clarity. On growth, the RBI has turned slightly cautious. FY27 GDP growth is now projected at 6.6%, down from 6.9% earlier. This downgrade reflects global challenges like geopolitical tension, supply chain disruptions, and high commodity prices. However, domestically, the economy is still holding strong. We are seeing resilient urban consumption, strong services export, healthy credit growth, and stable manufacturing and services activity. Quarter-wise, GDP growth is expected at 6.6% in Q1, 6.3% in Q2, 6.5% in Q3, and 6.8% in Q4. Now, inflation. This is where things get interesting. Recent data shows CPI inflation at 3.5% in April 2026, which is still below RBI target of 4%. But going forward, the RBI expects inflation to rise to 5.1% for FY27, which is 50 basis points higher than earlier estimates. This increase is due to higher crude oil prices, supply disruptions, and potentially weak monsoon risk. Quarterly inflation is projected at 4.2% in Q1, 5.1% in Q2, 5.9% in Q3, and 5.4% in Q4. Core inflation remains stable at 3.7% and even lower at 2.1 to 2.2% when excluding precious metals, suggesting demand is still under control. To manage global volatility and support the rupee, the RBI has taken proactive steps like allowing FPIs to invest in 30 and 40-year government bonds, supporting hedging costs for FCNR deposits, increasing investment limits for NRIs and OCIs, and offering concessional swap facilities for PSU borrowings. Liquidity also remains strong, averaging at 2.63 lakh crore daily surplus since April. Plus, a $5 billion forex swap was conducted in May to stabilize the markets. From a research perspective, this policy is best described as a hawkish pause. The RBI has acknowledged that inflation risks are rising, driven by geopolitical tensions, elevated crude oil prices, and risk of El Nino-led food inflation. However, instead of tightening the policy immediately, it chose to prioritize growth and remain data dependent. The RBI has been proactive in using liquidity and capital flow measures to shield economy from external shocks and rupee volatility. Going forward, the path is conditional. If crude oil prices stabilize and monsoon is favorable, inflation could ease, supporting rate-sensitive sectors like banks, NBFCs, capital goods, and infra. But if energy prices remain high and monsoon disappoint, we could see the RBI turn more hawkish later in FY27. In short, this is a calibrated wait-and-watch stance in an uncertain global environment. If you found this video useful, don't forget to like, share, and subscribe for more sharp market insights.
Investment in securities market is subject to market risk. Read all related documents carefully before investing.